Good morning, dear students. How are you all? Good morning, everyone. Okay,
Good morning, sir. We are perfectly fine.
good morning. So, we were into the chapter of business valuation, and we've covered quite a good number of concepts, and few numerical questions are pending now. Okay, I think what we have covered is we've covered the net, not net operating. Yeah. So in business valuation, we have done the various methods of obtaining the corporate value, which will be based on cash flow model, income-based model, asset-based model, free cash flow model, and of course, we've done good number of questions also, and we have reached up to the point of economic value added, EVA, right? And in EVA, we have done certain questions. We've done what, question number 9? Yeah. So we've done one question on business, on the economic value added part. Now let us take up some more questions on the same lines of economic value added, and then we'll go with the extensive questions which will involve use of FCFE and FCFF for business valuation. Okay, so let us take up the question number 10 now, guys. Let's look at question number 10. Question 10. RST Limited's current financial year income statement reported its net income after tax. Net income after tax as 25 lakhs. So when you say net income after tax, we are talking of obviously the PAT figure, the profit after tax figure, right? So we have a profit after tax of second, guys. So we have a profit after tax of 25 lakhs. Corporate tax rate is 30%. Following the capital structure of RST at the end of current financial year. So we have the capital structure available with us, share capital, debt, and total invested capital. Okay, so we have the total capital employed as 165 lakhs. Following data is given to estimate the cost of equity. So we have the beta available to us as 1.36. The risk-free rate, RF, is 8.5%. Market risk premium, which means RM minus RF, is 9%. You first get the weighted average cost of capital and then the economic value added. So can we get this done? Can you do it? Would you like to try it, everyone? Would you like to give it a try? Or you want me to solve it?
We will try.
We'll try. Just a couple of minutes quickly. Try to, jumble up the numbers and try to get the answers quickly. So you should start with calculation of KE.
Cost of equity.
Right? And then after KE, we need to also get the post-tax KD. Then you have to get the weighted average cost of capital, KO. Right? And once you have that, then you need to get from PAT, you need to arrive at PBT and then at EBIT. And then you convert it to net operating profit after tax, which is no PAT. So PAT, PBT, EBIT, and then net operating profit after tax, no PAT. Okay. And then once you have got the no PAT, then we can definitely calculate the economic value added. So cost of equity will be RF plus beta into RM minus RF. So RF is 8.5% plus 1.36 into
9%.
9%. So how much is the cost of equity?
20.74. 20.74. 20.74. 20.74.
20.7.
74.
20.7. Okay. Yeah. Cost of debt
Will be 7.7.
So for that we have the coupon rate as 11%, right? So coupon rate is 11%. So interest into
1 minus
1 minus
tax.
2. So 11% into 1 minus 0.3. So how much is that?
7.7.
7.7%. Then weighted average cost of capital. For that we have the amount of debt, we have the amount of equity. So we take it as amount of debt is what? 40 out of 165. So 40 out of 165 is the weightage of debt into 7.7% plus 125 out of 165 into 20.74. So what is this weighted average number? Weighted average cost of capital, what is this? Yes.
$17.58.
17.58. So you've got the PAT as 25 lakhs. PBT will be 25 lakh divided by 1 minus 0.3. So what's the PBT number?
17,50,000.
So 25 divided by 0.7. That's 35 lakh 71,429. Right? Because it's a PAT, so we need to make it before tax number. So 25 lakh divided by 70%. And then EBIT will be 35 lakh 71,429 To that, we just add the interest component. What is the interest amount? Interest will be 11% of 40 lakhs, which is 4,40,000. 35,71,429 plus 4,40,000, which is 40,11,429.
Yes.
That's your EBIT. What will be the no PAT, which is net operating profit after tax? 40,11,429 into 1 minus 0.3, which is this into 0.7, which is 28,08,000. So the economic value added will be no PAT minus total capital employed into KO. So no PAT is 28,08,000 minus total capital employed of 165 lakhs into KO is 17.58%. So what is this number? 28 lakh 165 lakhs into 17.58% minus 28 lakh 8,000. So we have a economic value added to be 90,700 negative. Correct, guys? Yeah. Let's check. Are you all getting this 90,700 EVA negative? Yes, everyone?
Yes.
Yeah, okay.
Yes.
Sure, great. So that was question 10 for us. Now, look at question number 11. So Tender Limited has earned a net profit of 15 lakhs after tax of 30%. Interest cost charged by financial institution was 10 lakhs. Invested capital is 95 lakhs, of which 55% is debt. Company maintains a weighted average cost of capital of 13%. What we require is the operating income and the economic value added. And also, tender capital has 6 lakh equity shares outstanding. How much dividend should the company pay before the value starts declining? Now, leave apart the third part. Try to get these two parts, part A and part B. Will you be able to solve it? Part A and part B, guys?
We will try. Try. We will
Yeah, you
try.
can do it easily. Just like the previous question. Right, guys?
Operating income comes to 31,42,857.
Okay. So we have a net profit, which is a PAT of 15 lakhs. So PAT is 15 lakh. So what will be the PBT? It will be 15 lakhs divided by
70%.
70%. So that gives us a PBT of
21,42,857.
uh, 21,42,857. And then we'll get the EBIT as 21,42,857
Plus 10 lakhs.
plus interest cost
Interest,
is
10
10 lakh,
lakhs.
which is 31,42,857. So 31,42,857, that's your EBIT. And then we have to get the NOPAT, net operating profit after tax. That's 31,42,857 into 1 minus 0.3 into 0.7. So NOPAT is 22 lakhs.
22 lakhs.
Okay. Now we can get the EVA simply as 22 lakhs of net operating profit after tax into this NOPAT minus weighted average cost of capital is what, 13% of 95 lakhs. So 95 lakh into 13%. 12,35,000 minus 22 lakhs. Shit. So EVA is how much, guys? 9 lakh
9,65,000. 9,65,000.
Yeah, 9,65,000. Okay, so that's your economic value at 9,65,000. Now, since we have this EVA as 9,65,000, this simply means that the additional value which the company has generated is worth 9,65,000. right? So the additional value which company has generated is 9,65,000. Okay. And this is the amount of dividend which you can give without any reduction in the value of the company. If you're going to pay dividend more than this, obviously the value of the company is going to take a hit, right? So when you have this 6 lakh equity shares, how much dividend can the company pay before the value of the entity starts declining? So we will say max dividend per share that can be paid.
Sir, we will take 22 lakh, no?
22 lakh. Why?
Here in EVA, we have taken 21. We
No,
get
it is
no paid.
22 lakh.
Yeah, we get no paid at 22 lakh, but at the
Yeah.
time of calculating EVA, we have taken it 21 lakh.
No, it is 22 only.
Okay, sir.
So it's what, 95 lakhs into 13% minus 22 lakhs. It's 22 lakh only. Yeah. So max dividend per share that can be paid is 9,65,000 divided by what's the number of shares?
6 lakh.
6 lakh. This divided by 6 lakh. So that is 1.61. That is the maximum dividend that we can pay before the company value starts declining. Okay, everyone?
Okay, sir.
Fine. So that was question number 11. Now, question number 12 is. So what three companies, Orange, Grape, and Apple, we've got the invested capital, debt to assets ratio, shares outstanding, pre-tax cost of debt, cost of equity, and EBIT is given to us. Compute the weighted average cost by the tax rate is 35%. So to get the weighted average cost, you have to get the economic value added. Based on the economic value added, which company would be considered for best investment? And then we have to also look at what will be the price of the share if the industry P is 11x, and also compute the estimated market capitalization for each of the companies. The market capitalization will be, of course, market price per share multiplied by the number of shares. Okay, so just give it a try, guys. Try to solve this. You can just solve it in the form of a table. Steps are going to be the same. We have the EVIT. First, we need to get the NOPAT. Then we'll have to get the first the weighted average cost, which is KO, and then we have to get the EVA. And also we have the EBIT. From that EBIT, we have to reach up to PAT and then EPS, and then multiplied by the P ratio to get the market price per share. Just try to solve it, guys. Okay. So for all three companies, Orange, Grape, and Apple, we first have the EBIT. So let's first get the NOPAT. So yeah, the EBIT numbers as same, in fact, 25,000 for all the three companies.
Yes, sir.
Right, so 25,000 for all three companies. Now we can make it a NOPAT figure by simply subtracting 35% from that. So 25,000 into 30, I mean post-tax, I have to make it post-tax. So 25,000 into 0.65. Great, so this is going to be EBIT into 1 minus 0.35. Right, so NOPAT for all the three companies, for all three of them, that is how much? 25,000 into 0.65, which is 16,250, right? So NOPAT is same for all three of them, but the weighted average cost and the EV is going to be different. So for that, we have the weightage of debt, weightage of equity, and then we need to get the cost of debt and the cost of equity also. So weightage of debt, in case of Orange, it is debt to assets. So that's obviously the weightage of debt, which is weightage of debt is 0.8, 0.5, 0.2, and weightage of equity is of course going to be 0.2, 0.5, and 0.8. And then the cost of debt. Cost of debt is going to be, we have the pre-tax cost of debt as 16%, 13, and 15. So let's make it post-tax. So cost of debt will be 16% into 0.65. 10.4%. Then next it is 13% into 0.65. Right, so 13 into 0.65, which is 8.45%. And then 15 into 0.65. So that's 15% into 0.65, which is 9.75%. Okay, so that's your cost of debt, 10.4, 8.45, 9.75%. Now coming to cost of equity, that's already given to us directly. Cost of equity is directly given to us, which is 26%, 22%, and 20%. So 26%, 22%, and 20%. So now we can get the weighted average cost of capital, which is KO. So KO is 0.8 into 10.4% plus 0.2 into 26%. So what's the weighted average cost in case of the first company? What is KO for the first company? Here is 0.8 into 10.4 plus 0.2 into 26%.
30.52.
30?
0.52.
13.52.
Yeah, 13.52%. Then second case
15.225.
is 0.5 into 8.45% plus 0.5 into 22%. Yeah, how much is this?
15.225%.
18 point
15.225.
15.
Yes, sir.
15 point
225.
225. Okay, let's keep it 2-3%. Then in case of Apple, it is going to be 0.2 into 9.75% plus 0.8 into 20%. Okay, so just add them it. What is this Q?
It's 17.95.
17.95%. Okay, this is the Q. Now we have the total capital employed. Totally invested capital is anyways 1 lakh
Let's
in all three companies, right? So that's 1 lakh in all three companies. Now, what will be the EVA? EVA will be NOPAT minus total capital employed into KO. So NOPAT, we know NOPAT is 16,250 minus 1 lakh into 13.52%. So 16,250 minus 13,520. This is 2,730. Then this is going to be, next is 16,250 minus 1 lakh into 15.23%. Minus 15,230, which is 1020. And then finally we have the next as again 16,250 minus 1 lakh into 17.95%. So 16,250 minus 17,950, which is negative 1,700. Two seven three zero 1020 and negative 1,700. So these are the EVA that we have. So we got the weighted average cost, we got the EVA. Based on EVA, which company would be considered the best for investment? Of course, based on EVA, the first company, which is orange, is supposed to be the best one. Then, if the industry P ratio is 11x, estimate the price for each of the shares. Now, to estimate the price, we have the P, but we need to get the EPS also. So you have to start with EBIT. EBIT is 25,000 in each case. From this, we are going to subtract interest. Right? Now, the amount of interest will be computed as total capital is 1 lakh. Out of that 1 lakh, 80% is debt. On that, we are paying 16%. So it is going to be 1 lakh into 80% is debt into 16%. So this is 1 lakh into 80% into 16%, which is 12,800. In the second case, it's going to be 1 lakh into 50% into cost of debt is what, 13% over here before tax. So the rate of interest is 13%. So 1 lakh into 50% into 13%. 6,500 is the interest cost. And then this is 1 lakh into weightage of debt is 20% into cost of debt is what, 15%. This is 1 lakh into 20% into 15%, which is 3,000. Now, after subtracting that, we get the value of PBT. 25,000 minus 12,800, which is 12,200. 25,000 minus 6,500, which is 18,500. 25,000 minus 3,000 is 22,000. That's your PBT. From that PBT, you are going to subtract tax, which will give you PAT. So tax rate was what? 35%, right? So 12,200 into 35%, which is 4,270 tax. So 12,200 minus 4,270, which is 7,930 is the profit after tax. And then for the second company, it's going to be 18,500 into 35%, which is 6,475. 6,475. So that's 12,025. Then for the third company, it is 22,000 into 30%, sorry, 35%, which is 7,700. It is 14,300. Okay. This is your PAT figure. Now I need to divide it by number of equity shares. So number of equity shares we have 6,100, 8,300, and 10,000. This will give us EPS, earnings per share. So earnings per share 7,930 divided by 6,100. This is 1.3. Then 12,025 divided by 8,300. This is 1.45. 14,300 divided by 10,000 is 1.43. And then P ratio. P ratio is given as industry P is 11. So this is 1.3 into 11, which is market price per share of 14.3. Then 1.45 into 11, which is 15.95. And 1.43 into 11, which is 15.73. This is the market price per share. Now, once you have got this market price per share, we have to get the market capitalization. Now, market capitalization will be market price per share into number of equity shares. So 14.3 multiplied by 11, which is 157.3. 15.95 into 11, which is 175.45. And then 15.73. One second. 15.95 multiplied by 8,300. Sorry. I think we got this wrong. NPS is arrived at 14.3 into number of shares is 6,100. So that is 87 to 30. Then it is 15.95 into 8,300. into 8,300. This is 132,385. And then finally it is 15.73 into number of equity shares is 10,000, which is 157,300. So 1,57,300. That's your market cap. Okay. That's your market cap, and that's, I think, the last part that we had required for the question. Were we all able to get these numbers?
Yes.
Yeah. Fine. So that was our question number 12. Now let's go for question 13. So read question number 13, guys, and just let me know if you can solve it. Do it question number 11. Sorry, not 11, sorry. Question 13. And just confirm, is it a doable one? Question 13.
We can try.
Hmm?
We can try.
Yeah, you can try. Sure. Give it a try, guys. Try to solve it quickly. Question 13. So Delta Limited's current financial income statement reports a net income of 15 lakhs. So this is basically your PAT. Delta's marginal tax rate is 40%, and its interest expense for the year was 15 lakhs. So marginal tax rate is 40%, and interest expense is given. Company is having 1 crore of invested capital, of which 60% is debt. In addition, the Delta Limited tries to maintain a weighted average cost of capital of 12.6%. We have a WACC of 12.6%. Compute the operating income or EBIT given by Delta in the current year. You have to compute the EBIT, right? So which is obviously PAT is your reverse calculation. Then you have to get the EVA, and then how much dividend we'll be able to pay. Similar to the previous questions. Try to solve it, guys. It should take you what, around approximately 4 minutes, not more than that to solve. Okay, so let me get started now. So Delta Limited's current financial income is a net income of 15 lakhs. So we have got a PAT of 15 lakhs. Right, so with PAT being 15 lakhs, tax rate is right. Tax rate is 40%. Okay, so we get the PBT as 15 lakhs divided by 1 minus 40%, which is 60%. So 15 lakh divided by 0.6, which is 25 lakh. So PBT is 25 lakh. And then we'll get the EBIT.
EVA comes to 11 lakh 40,000.
Okay. So this will be 25 lakh plus an interest expense of 15 lakh. So EBIT is what? 40 lakh, guys?
Yes.
Correct?
Yes.
EBIT is 40 lakh. Then your net operating profit after tax.
24 lakhs.
Net operating
40
profit after tax is
40 lakhs into 1 minus 40%.
EBIT into 1 minus T, which is 40 lakhs into 1 minus 0.4. So 40 lakh into 60%, which is 24 lakhs. So net operating profit after tax is 24 lakh. Okay.
Yes.
So net operating profit after tax is 24 lakhs. Now, once we have got the NOPAT as 24 lakh, now you have to look for the weighted
Economic
average cost
value.
of capital.
It is given 12.6.
Weighted average cost of capital is already given. Total capital employed is 1 crore.
1 crores into 12.6%.
Right, 1 crore. And even we have the KO, or weighted average cost of capital, is 12.6%. So what is EVA? EVA is NOPAT of 24 lakh minus total capital employed of 1 crore into 12.6%. So 24 lakh minus 12 lakh 60,000. That's 11 lakh 40,000.
Yes.
Right? So economic value added is 11 lakh 40,000. So EVA is 11 lakh 40,000, guys. Now once you've got this EVA, the next part is if it has 2 lakh 50,000 shares, how much dividend can be paid per share? So max dividend per share will be 11 lakh 40,000 divided by
2 lakh 50,000.
2 lakh 50,000 shares.
4.56.
Yeah. Max dividend that can be paid is 4.56. And if Delta does not pay any dividend, what would you expect to happen to the value of the shares? If no dividend is paid by Delta, value of company will increase. Okay. If no dividend is paid by the company, if no dividend is paid by Delta, then the value of the company is going to increase. Okay, guys.
But it will affect the market price of the shares.
Then what would you expect if company does not pay any dividend? What would you expect to happen to the value of the company? It will increase. Value of the company increase. That is something which they're not asking for the new market price or anything, because for that we have not been given the PE ratio.
No, not
Got it?
given. I was just saying.
Sorry.
I was just saying that market, it will affect the market. If no dividends
Yeah.
are paid,
Mhm.
it will affect the market price.
Yeah, it is a bit affecting the market price. Okay. So that was question number 13. Then let's go for question 14 now, guys. Question 14. The following data pertains to XYZ Inc. engaged in software consultancy, wherein we have income from consultancy, EBIT of 180 less interest on loan is 18, EBT is 162, tax is 56.7. So you have a PAT of 105.3. Balance sheet is given, summarized form: equity, reserves, loans, current liability, land and building, computers, and current assets. With the above information and following assumptions, you are required to compute economic value added and also market value added. Assuming that WACC is 12%, shares of the company currently quoted at rupees $50 each. So forget about market value added. Can we calculate the EVA? We can calculate the economic value added, right?
Yes, sir.
Correct this? Yeah. We can calculate the economic value added at least now.
Yes.
Yeah, sure. Give it a try. Give me the economic value added number directly.
The economic value added comes to 66 million.
66?
Yes.
Okay. So let me just quickly solve it. Economic value added will be 180 into 0.65 minus total capital employed is 100 plus 325 plus 180. 100 plus 325 plus 180, which is 605. 605 into the tax rate is 12%. So 180 into 0.65, which is 117, minus 605 into 12%, which is 72.6. So 117 minus 72.6, which is 44.4, right? EVA?
Okay,
Yeah.
loan is also to be taken into consideration.
Yeah. So loan is taken up, right? So because that's 100 plus 325 plus loan of 180. Yeah. Total capital employed. No? We are taking total capital employed, not the only equity component. Did we get it?
Yes, got it.
So EVA is 44.4. Now coming to the next part, which is market value added or MVA. MVA or the market value added. MVA is simply whatever is the market value, right? So market value added, as the name says, is like what value addition have been bought in the market value as compared to the book value. So it's going to be simply market value of the company minus, right? Or you can say it's going to the market value of equity minus book value of equity. So we have the market price available to us. The shares of the person are currently trading at 50, right? So 50 into the number of shares is 10 million shares minus the book value. Book value is going to be 100 plus 325 only, which is the capital and the reserves. So this is going to be 500 minus 425, which is 75. So market value added is 75. So market value added is 75. Right? So market value added is simply you take the value of the company in the market, which is value of the equity shares in the market, and from that you're going to reduce the equity and the reserves. From that you're going to reduce the equity and the reserves value. Okay, so it's like market value of equity minus the book value of the equity. That's question number 14. Now, next, question 15, guys. Have a look and just check if you can solve it. Question 15. Can we solve it, guys? Question 15. Can we solve this question number 15, guys?
Yes.
Yeah, sure. Give it a try. Try to solve it.
The tax rate is not given here.
Tax rate is,
Not given. So how to arrive at NOPAT?
so there is no tax. Whatever is your EVAT, that itself is the NOPAT then.
Okay.
So Herbal Gyan is a small but profitable producer of beauty cosmetics using the plant aloe vera. This is not a high-tech business, but Herbal's earnings have averaged around 12 lakh after tax, largely on the strength of patented beauty cream for removing the pimples. The patent has 8 years student. Herbal has been offered 40 lakhs for the patent rights. Herbal's asset own include 20 lakhs of working capital, 80 lakhs of property, so total 100 lakhs of capital investment. And the patent is not shown on Herbal's book. Shows Herbal's the cost of capital is 15%. What is your economic value added? So in fact, whatever you have, the 12 lakh, that itself will be your NOPAT, because we don't have the information about the debt also component, right?
Right. It comes to minus 3
Hmm?
lakhs. Minus 3 lakhs. EV
Minus
3.
3 lakhs. Okay. It is small but profitable. So we have a NOPAT over here, simply calculated as net operating profit after taxes, 12 lakhs. From that, we are going to subtract total capital employed into KO. So total capital employed is 100 lakhs.
Yes.
100 lakh into cost of capital is 15%. So we
Yes.
have this as 15 lakh. And then we have the net as 3 lakh. Right. So net is going to be 3 lakh. So this is going to be what? Your EVA, it's economic value added, which stands as 3 lakh. Okay. Then question 16. Try out question 16, guys. Should be able to get it. Try out question 16.
Sir,
Hmm.
patent that not taken in the 15th question.
Sorry. Patent.
Patent value in the total assets.
Uh-huh.
Total, total assets does not include patent value.
No, it whatever is the capital employed, that is only going to be considered. Right. So that is not, I mean, the patent is not something which we have invested, right? Which the company has invested. What has been invested in the company is the working capital and the property, plant, and equipment.
Okay.
Okay. So that's not a capital employed.
Sir, but in the answer in the study material, patent
Mhm.
also taken.
Patent is taken. 1 second. Then 1 second. There is no high tech business, but it averaged 12 lakh. Okay, so it is having this patent, right, on the strength of the patented beauty cream certificate. So patent is having a life of 8 years to run and it has been offered 40 lakhs. Okay. So ideally we should be taking like whatever money has been spent to acquire the patent, but since that has not been given, then yeah, we'll have to take because this is there in the books of accounts. So okay. So total capital employed, it could be like this, equity share capital plus reserves plus debt, right? Or to put it other way around, we can also say it is total assets minus current liability. Now, total assets will include your fixed asset plus current asset minus current liability, and your fixed asset is going to include uh, the tangible assets as well as intangible asset. Okay, and since this is an intangible asset which the company has uh, prepared it, I mean, company has bought it, and it is not something which has automatically arisen, and therefore we will be including over here. Yeah, true, guys. Because the question is saying that it is largely on the strength of patented beauty cream, and the patent is still having a life of 8 years to run. Had it been, the patent has lost its life, or patent is something, which is not there in the books, then we would have excluded. But yes, we will include it. True. So the total assets will be what? 80 plus 20 plus 40, right? 80 lakh plus 20 lakh plus 40 lakh into what's the weighted average cost? 15%. So the numbers will be 140 into 15%. Still, you have like a negative EVA of 9 lakhs, right? Correct, Leela? Hello, Leela?
Yes, sir. Okay, sir.
Yeah, got it. So since we are talking of total capital employed, you can think it from the one point of view of the liabilities or from the point of view of asset. And now in assets, this intangible, if you are having it in your books of account and if you have invested money to get it, then you should have it. But remember, if they're talking of goodwill, company is having some sort of goodwill, that will not be considered in the intangible asset because that is not something for which the company has put up the capital. Patent is definitely company has developed and therefore that should be included. Okay. Third question.
Okay.
16. Question 16, guys. Sixteenth one, guys. Are you able to get it? 16th question. Again, here the patent is there. The net worth of Constant Engineering Limited is 200 crores. Long-term debt is 400 crores. The product generates a revenue of 84 crores. Try to get the EVA over here. So first you have to get the EBIT into 1 minus T.
Cost of equity would be 12%.
Of equity will
Applying
be
this
12%.
CAPM,
Okay, it moves in tandem with the market. Yeah, so it will be 12%. Yeah. Okay, so first let us try to get the NOPAT, net operating profit after tax. What is the NOPAT given to us? The revenue of 84 crores. And there's no other cost which is given to us. So net operating profit after tax is 84 crores. So NOPAT is 84 crores. From that, we have to get the EVA. So for that, I need to get the weighted average cost of capital. So weighted average cost of capital is cost of equity will continue to be 12%. Okay, guys, cost of equity will be 12%. So let me first get the KE. KE is the risk-free rate is 10%. So we are going to follow the CAPM. So risk-free rate plus beta into RM minus RF. So risk-free rate is 10% plus
beta would be 1.
beta would be 1. And market rate of return is 12%
12.
minus 10%. That is ultimately 12% itself. What about cost of debt? What will be the cost of debt? Long-term debt amount is given, but cost of debt is not given. So we'll assume that cost of debt is same as your risk-free rate, which is 10%. Okay, if no information is given, you can definitely assume that the risk-free rate is the same as the cost of debt. Now we can get the KO, or the weighted average cost of capital, right? So for KO, I need to first look at what is the total capital employed. Now, total capital employed is going to be,
Net worth plus long-term debt.
yeah, so we have a net worth of 200, long-term debt of what, 400? But one
Yes.
thing we need to also take into account is the patent. Patent is something the company has generated and that will be added to our net worth. So owned funds will be considered as 300, right? And you have the borrowed funds as 400. So total capital employed will be 700. So weightage of equity will be 3 out of 7. Weightage of debt will be 4 out of 7. So you can get the KO as 3 by 7 into 12% plus 4 by 7 into 10%. So how much is this going to be? 12 into 3, which is 36 by 7, plus 40 by 7, which is 56 by 7. So that is 8%, right? No, one second. It's not 56, it's 76, right? 76 divided by 7, which is 10.86%. So KO is 10.86%. Cost of capital, KO is 10.86%. So we got the KO. We have the NOPAT also. We can definitely get the EVA now. So how do we get the economic value added, guys? Economic value added will be NOPAT of 84 lakhs minus overall cost of capital, which is total capital employed, into KO. So net operating profit after tax is 84 lakh minus total capital employed is of 700 lakhs into KO of 10.86%, right? So this is going to be what? 84 lakhs or crores or whatever, I don't know. So 84 minus 700 into 10.86. How much is the EVA?
Eight.
Hmm?
Like 8
How much? Sorry?
like
How much is the EVA?
8
7,
crore.
8.8
8 crore. 8 crore. Exact.
crore. 8 crore. Okay. 700 into 10.86, which is 100.
70.
76 and then minus 84. Yeah, so that's 7.98. 84 minus 700 into 10.86.
Is 7.98.
7.98 crores. Or approximately 8 crores is the EVA that is generated by the company. Okay, so with regards to this, we have completed question 16. There are a couple of questions pending to be done, which is, I think, questions 7 and 8. These are the two questions which we haven't yet covered till now. So we'll take a break now, guys. And after the break, we will look into these two questions, which is question number 7 and question number 8. Okay. Let's take a break, guys. Post break, we'll do these questions and then we'll go for the MCQs. Let's take a break, guys. a couple of questions to complete, which was, I think, questions 7 and 8. So let's get started with question number 7, guys. Question number 7. Just have a quick read about it. Read it quickly, guys. Question 7. Read it, guys. Question number 7. Following information are available in respect of XYZ Limited, which is expected to grow at a higher rate for 4 years, after which the growth rate will stabilize at a lower level. So you have a higher growth rate for 4 years, after which the growth rate is going to stabilize at lower level. Revenue is 2000 crores, EBIT is 300 crores, capital expenditure is 280 crores, depreciation is 200 crores. Information for high growth and stable growth period are as follows. So we have the high growth numbers and the stable growth numbers available with us. For all time, working capital is expected to be 25% of the revenue. So working capital is expected to be 25% of the revenue, guys. Okay. And the corporate tax rate is 30%. You have to get the value of the firm. Now, of course, when you want to get value of the firm, I need to take the present value of all future cash flows for the firm, or FCFF, free cash flow for the firm. Okay, so here we need to have a calculation about what is the KE in high growth phase, KE in stable growth phase, cost of debt, cost of equity, and everything needs to be taken care of. Okay. So we have two phases, high growth phase and the stable growth phase. So let's first try to do the calculation, certain basic information for the high growth phase, and then we'll go ahead with the stable growth phase numbers also. Okay. Now, so I'm talking of high growth phase. High growth phase. High growth phase, we have KE. Right, so the KE for high growth phases is equity beta is 1.15. So we have a risk-free rate of 10% plus equity beta of 1.15 into K is 10%, equity beta is 1.15 into market risk premium is 6%. So this is going to be 10% plus 1.15 into 6%. What is this K number, guys? High growth phase, what's the K? So 1.15 into 6 plus 10. 1.15 plus 10. How much is the K in high growth phase? K in high growth phase is
16.9.
16.9. Okay. 16.9% is the high growth phase K. Then we also need to get the cost of debt. Pre-tax cost of debt is given to us. Pre-tax cost of debt is 13%. Pre-tax cost of debt is 13%. So it will be post-tax cost of debt. Post-tax cost of debt is 13% into 1 minus 0.3. How much is it?
9.1.
9.1. Right. So we have the post-tax cost of debt is 9.1%. Then what will be the overall cost of capital, KO? So for that we have weight of equity into K plus of weight of debt into KD. What is the weight of debt and equity? Well, now the debt equity ratio is 1:1. So of course, weightage is going to be 0.5 into 16.9% plus 0.5 into 9.1%. So what's the total? 0.5 into 16.9 plus 0.5 into 9.1. 0.5 into 16.9 plus 0.5 into 9.1. Total? 13%?
13. Yes.
13%, right? Same way, can we get the numbers for a stable growth rate also? Get these numbers for stable growth phase. Get these same numbers for the stable growth phase, guys. Calculate these numbers for the stable growth phase. Get these numbers for stable growth phase. What's the KE in stable growth phase?
14%.
14%. Perfect. Then what's the KD in stable growth phase?
9.002%.
9%. And what's KO?
12%.
12%. Perfect. Now we have to go for calculating the FCFF. So let's go for calculation of free cash flow for the firm. Now here we have this free cash flow for the firm. It's going to be higher rate for 4 years. So base year information, which is year 0, is given to us. EBIT, CAPEX, depreciation figures are given. And growth rate in the high growth phase is given, which is also given the growth rate in the CAPEX and depreciation. And also, for all time, the working capital is 25% of revenue and corporate tax rate is 30%. So working capital needs to be calculated taking this into account. Now, calculation of free cash flow for the firm. The format that we have for calculating the free cash flow for the firm is, we have like year, beginning with year 1, 2, 3, 4, and then the terminal year, which is the year 5, right? So we have revenue. From the revenue, we will derive EBIT, right? Then we'll make it as EBIT into 1 minus T because we want to compute the FCFF, right? So EBIT into 1 minus T. To that, we are going to add the depreciation figure. Then we're going to subtract the capital expenditure or investment in the fixed asset. Further, we're going to subtract increase in working capital. And then you have free cash flow for the firm, FCFF. Okay. Let's talk of the revenue numbers. So revenue we have what? So revenue is what? 2000. 2000 that was in base zero, the base year year zero. We want it for subsequent years. So in year one, the revenue is going to be 20% higher. So revenue will be 2,400. Then every year it's going to increase by 20%. Right? And what about the EBIT? EBIT is 300. And they're saying revenue and EBIT both are going to increase by 20%. So this is also 360. Then you can get obviously EBIT into 1 minus T, which is nothing but EBIT into 1 minus 0.3, which is the post-tax EBIT. We'll add back the depreciation. And further, they're saying that the capital expenditure and depreciation are both going to increase by 20%. So depreciation is 200. So that's going to increase at 20%. So that's going to be 240. Capex is also going to grow by 20%. That will be 336. Now, increase in working capital is something we'll have to do the working note. So let me do the working note over here. Working note number 1. Increase in working capital. We're looking at increase in the working capital that we're going to have. So the increase in working capital we can have the increase in working capital number by first calculating the working capital that will be needed. So we have year 0, year 1, year 2, year 3, year 4, and year 5. So we need to have the revenue. Revenue is 2000, and every year you're going to have the amount of revenue. Now the working capital is going to be 25% of this. So year 2 it is 2400. So working capital 25%, it means 500 over here, but here it is going to be 600. So if I ask you what is the increase in working capital, here it is increasing is 100. Next year, of course, the revenue is going to be 20% above 2400, which is 2880, and working capital is going to be what, 720. So the additional working capital that we needed is 120, right? Then in the third year, the revenue is going to be again 20% higher, which is 3456, and working capital will be 25% of 3456. How much is 25% of 3456?
864.
864. So by how much is the working capital increasing? Working capital is increasing by what? 144.
144.
Then year 4, what's the revenue value? 20% higher than 3456.
4147.2.
414.
7.2.
Okay, year 4, the sales figure is 4147.2. Then working capital will be 25% of this, which is
1036.8.
1036.8. Okay, so what's the increase in working capital?
172.8.
172.8. Then year 5, terminal year, but now the growth rate is how much? In year 5, how much is the growth rate? Because from year 5 onwards, you have a stable growth rate coming in. So growth in revenue and EBIT now it is 10%. So 4147.2, add to it 10%. How much is the revenue?
4561.92.
Yeah, 4561.92, and 25% of that.
1140.48.
1140.48. So the increase in working capital is 103.68, right? That's the increase in working capital. So first year increase in working capital was 100, and we will get the FCFF in that on those lines. So the FCFF will be, just add them, 2400 plus 3600 plus, sorry, EBIT into 1 minus T. That is something that we need to first get. So EBIT into 1 minus T is what? 360 into 0.7. How much is this number? 360 into 0.7. 360. Sorry. 252. Okay, so this is 252. You add to it 240, less 336 and less 100. So what's the FCFF? 252 plus 240 minus 336 minus 100, which is 56. So the first year FCFF is 56. Same way, can you compute the FCFF for the remaining 4 years, guys? Can you compute the FCFF for the remaining 4 years? Can we compute it? FCFF for the remaining 4 years?
Yes.
Yeah, sure. Go ahead, guys. Get the FCFF for the remaining 4 years.
What would be the impact of this capital expenditure are offset by depreciation in the 5th year onwards? What is the implication of this capital expenditure are offset by depreciation?
Yeah, so when you say capital expenditure is offset by depreciation, so in the 5th year, your depreciation and capex, they are going to offset each other. You're just going to put them dash over here. They're going to offset each other. The depreciation and capex are going to be different. I mean, they're going to be ignored. So revenue is 2880, 3456, 4147. All of us are ready. 4147.2, and this is 4561.92. So EBIT is also growing at same rate. So 432, 518.4, 622.08, 684.29. ट्रॉमा पेज टिके ना एकदम टिके भी so EBIT into 1 minus T. So post-tax EBIT, basically this is 252, 302.4, 362.88. This is 302.4. This is 362.88. 435.46. And this is 479. Then add depreciation and capex. So depreciation and capex both are going to increase by 20% each. Right? So this is going to be 288, then 345.6, 414.72. Capex is also going to increase by the same thing. So it is going to be 403.2, 483.84, and this is 580.61. Now, both depreciation and capex are going to be ignored in the terminal year because they're going to offset each other. And then increase in working capital, as we have computed, 120, 144, 172.8, and 103.68. So calculate the FCFF, guys.
Yes, second year it is 67.20.
Okay. Second year it is 67.20. Third year
Third year 80.64.
80.64. Then
Fourth year 96.77.
96.77, and then
375.32.
okay, 375.32. Fine. So that gives us the value of FCFF. Now, when we want to calculate the value of the business, I need to take the present value of all these cash flows and also the terminal value. Right? So we have the calculation of value of business. So calculation of value of business, we have year cash flow, PV factor at 13% and then PV. So here 1, 2, 3, 4, 4. Cash flows are what? 56, 67.2, 80.64, 96.77. And of course, fourth year, I need to get the value in year 4, which will be FCFF in year 5 upon KO minus G. So FCFF is what we have got, 375.32 upon KO is overall cost of capital is 12%, so 0.12 minus the growth rate of 0.1 or 10%. Okay, so 375.32 divided by 0.12 minus 0.1. Okay, so that's going to be 375.32 divided by 0.02. So what's the terminal value?
18,766.
Okay, 18,766. That's the terminal value. We have 18,766. Take the PV factor at 13% and give me the total value. That will be the value of the business.
Up to 3 decimals or 4 decimals?
Take 3 decimals.
$11,720.94.
11,000?
720.94.
720.
0.94.
0.94.
720.94.
Okay. Some rounding off here and there, that's okay, acceptable. But this should be the value of the business by using the FCFF approach. Okay. Easy, guys?
Yes.
Okay, so last question that we have now is question number 8. Let's have a look at it. Look at question number 8. Just read question number 8, guys. Okay, so following information is given in respect of WXY Limited, which is expected to grow at a rate of 20% per annum for the next 3 years, after which the growth rate is going to stabilize at 8% per annum, normal level in perpetuity. Okay, so we have the revenue, cost of goods sold, operating expenses, capex, and depreciation, which is included in your operating expenses. During high growth period, revenues and earnings before interest and tax will grow at 20% per annum, and capital expenditure net of depreciation will grow at 15% per annum. So net capex we're talking of, which is less capex, add a depreciation part, that will grow at 15%. Year 4 onwards, a normal growth rate is going to be there, and depreciation capex are going to offset each other. During both high growth and normal growth rate, working capital will be 25% of revenue. WACC is given as 15%, and corporate income tax rate is 35%. We have the PV factors available with us for year 1, 2, and 3, and we have to estimate the value of the company using free cash flow for the firm and WACC methodology. So I'll just put forth a format in front of you so that you'll be able to get an idea what we are really thinking of or what we are really talking of. Just a moment. Okay, so here we have this question number 8 for you guys. You can just look at this format and try to obtain the values of revenue, COGS, operating expenses, right, based on the numbers that we have here. So we have revenue of 7,500 crores in year 0. Now we need the revenue and other numbers for the subsequent years. I'll just do one thing. Revenue is 7,500, and we say that the revenue is going to increase every year by 20%. Yes, or I'll just solve it in pen paper on the wait list. So here we will have like year 1, year 2, year 3, and year 4. So we have revenue, COGS, operating expense, depreciation. We get the value of EBIT. Then we take it as a EBIT into 1 minus tax. Right? And then after that, we have less net capex. Now, when I say net capex, it is capital expenditure minus depreciation. Less working capital increase. That will give us FCFF. So in year 1, there's a 20% increase. So revenue 7,500, on that 20% increase will be 9,000. Right? So every year it's going to increase 20%. So this will be 10,800. This will be 12,960. But when it is stabilizing, then the growth rate is going to be EBIT will grow at 8%. So revenue and EBIT is going to grow at 8% in year 4. So in year 4, it is going to be 13,997. Now COGS, of course, the proportion is going to remain same. In fact, COGS is also going to increase by 20%. Operating expense is also going to increase by 20%. Depreciation is also going to increase by 20% because the question says that EBIT is going to change by 20%. So COGS, it is 3,600, 20% increase. You can just calculate it. Operating expense also, this is going to be not 2250, but I have to take, excluding the depreciation part. Depreciation is 600. So operating expense will be 2250 minus 600. 2250 minus 600. On that, you add 20%. So how much is going to be the operating expense? 2250 minus 600. On that, you have 20% increase. So 2250 minus 600 into 1.2. How much is it? Two two five zero
1,980.
minus 600. This into 1.2, which is 20%. 1980. Now every year this 1980 is going to increase by 20%. In fact, the depreciation is also going to increase by 20%. So you get the EBIT. So how much is the EBIT? 9,000 minus 3,600 minus 1980 minus 720. 2,700. Let's make it post-tax by subtracting 30%. That will become 1890. Net capex. Net capex is going to be as given in the question. Capital expenditure is 750. From that, 600 is the depreciation. So net capex was 150 in the first year. So that's going to be 150 into 1.2. Sorry, 150 into net capex is going to increase by how much? Net of depreciation increase by 15%. So there's a 15% number given. So 150 into 1.15. So 172.5. Working capital change. That is something we have to work out. Working note number 1. Changes in working capital. So you have here 1, 2, 3, and 4. So first we take the sales, then the working capital, and then increase in working capital. So we have sales figures as what? 9,000, 10,800, 12,960, 13,997. So working capital is going to be 25% of this, right? We need your 0 also, by the way. 7,500. On that, 25% is the working capital. So 7,500 into 25%. Which is 1875. Working capital 1875. 9,000 into 25%. 2250. Then 10,800 into 25%, which is 2,700. Then 12,960 into 25%, which is 3,240. And then 13,997 into 25%, which works out to be 3,499.2. Now, increase in working capital will be just the difference. So over here we have this as 375. Next year it is 450. 450 Then next year it is 540. And then fourth year it is 3499.2 minus 3240. Which is 259.2. So 259.2. That's your increase in working capital. So increase in working capital is 375, 450, 540, and then 259.2. This will give you the FCFF numbers. Okay. So get the FCFF numbers quickly, guys. Give me the FCFF numbers.
Depreciation will increase by 15% or 20%?
Depreciation will increase by 20%.
Okay.
But the net capex is going to change by 15%.
You're muted.
अशोक जी, सर को कोस्ट कर दीजिए, कर दीजिए।
Okay, FCFF in year 4 upon KO minus G. The FCFF in year 4 is 2680.13 divided by KO. Cost of capital is set to be 15% and the growth rate is anyways 8%. So it's 15% minus 8% in the denominator. So this is 38,287.54. That's your value of the company in year 3. Now we have to take the present value of all the cash flows, which is year 1, 2, and 3. So the cash flows are 1342.5 and then 1619.63, 1953.47. And also in year 3, the terminal value 38,287.54, PV factor, and then the PV. So PV factor, we have to take it at 15% and then the present value. Okay, take the PV factors. 0.8696. Second year it is 0.7561 and then third year it is 0.6575. Right, multiply it and give me the total. Multiply and take the total, guys. It should be 1167.44, 1224.59, 1284.41, and then 25,174.06. And then just add them. Take the total. The 28,850. 28,850.5. That's the total of all present values. Okay, 28,850.5. That's the total of all present values.
Can you see the fourth year figures
Sorry?
above?
Hmm?
Fourth year figures. Can I see the fourth year figures above?
Yeah. So the EBIT is going to grow by 8% directly, you can say. Okay. So
Yes.
28,850.5. That's the value of the business using the FCFF approach. Okay, guys. Have it done? Shall we go for MCQ discussion?
Yes. Yes.
Okay. Okay, so here we have the MCQs. First question. What will be the answer for this, guys? So company reports the following for the year. Net income of 300. Depreciation expense is 80. Interest expense is 50. Capital expenditure is 120. Increase in working capital is 20. What is the FCFF? What is the FCFF? FCFF number for this, guys? So we can get the FCFF as net income being 300. So we add back depreciation of 80, right? Then we'll again add back interest, but post-tax interest. So 50 into 1 minus 0.3 minus capital expenditure of 120 minus working capital expenditure of 20. So the answer is what, 300 plus 80 plus 35 minus 120 minus 20.
275.
How much is it?
275.
275. So is option C, 275. Right? So that's 300 plus 80 plus 50 into 1 minus 0.3. Okay. Fine. Come to question number 2, guys. Question number 2. Sales is given to us. We have the EBIT of 400. Of course, since we have the EBIT, let us first take the EBIT 400, make it a post-tax figure. So EBIT into 1 minus 0.25. 400 into 1 minus 0.25. Then we add back the depreciation of 60, right? And subtract the capital expenditure of 150. And the capital expenditure of, working capital expenditure of 30. So yeah, so answer is 180.
Yes.
Right. So 180 is the FCFF, free cash flow for the firm. Okay. Then let's go for the third MCQ, guys. We have the EBIT, we have the tax rate, invested capital is given. What's the economic value added? So first we need to get the NOPAT, or the net operating profit after tax. So NOPAT is 500 into 1 minus 0.3. So that's 500 into 70%. So NOPAT is 350, right? And then we have to get the weighted average cost of capital into total capital employed. Now, weighted average cost of capital is 10% into total capital employed is 2000. So this is going to be what? 200?
150.
So
150.
economic value added is going to be 150. So correct option is option C. Then look at question 4. Shares outstanding are given, current market price is given, book value of equity is 18 lakh. What's the market value added? It's a very easy question. Market value added. First, you need the market value of shares. The market value of shares will be 10 lakhs into 25. On the other hand, book value of equity is that's 18 million. So we have the market value added as 25 minus 18, which is 7 lakhs. So option C is the correct one. Okay, last question. Question number 5. Answer me, guys. What's the answer for this? Investor capital is given, WACC is given, EBIT is given, tax rate is given. So EVA can be easily computed. So how much is going to be the EVA? EVA is 600 into 75%, which is 1 minus tax rate, minus 3000 into WACC of 8%. So EVA is 210. Now for market value added, we just have to take the market value added number as the value of the equity, market value of the equity, which is 3,800, minus book value of the equity, which is 2,000. So that's 1,800. So correct option is option D. Right, guys? Because the final market value of the firm, market value of equity is 3,800, and we have the market value added to be, market value of the equity minus the book value of the equity, which is 1,800. So that's going to be option D, guys. Okay. So with that, we are through with this topic of the business valuation, guys. So we have covered extensively how do we value the business using FCFF and HCFE approach. We have also covered what's EVA, what's market value added. So if you have any queries right now, we can definitely discuss that, or else we can just call it a day. Over to you guys now.
Thank you, Jagbandhu sir. And your MCQs were very good. In fact, they were very interesting. I find it's your own creation. So I thanks a lot for your effort that you have put in making this MCQ session very interesting. So student, with this, we have come to the end of the chapter business valuation. So almost there is only 2 chapters have been left, that is merger acquisitions and corporate restructuring. Now business valuation is a basis for the same. So with this, we have completed the chapter, we can say we have completed chapter 13. We have completed out of 15 chapters of our syllabus. Now, student, if you have any still, of course, sir has opened the session for you. Now you have any query, you can ask the same. But still, if you have any query, you can contact us. Sir, share our number. Yes. So this is our number. This is our email ID and is a telephone contact number. Of course, for the last 2 days, I was busy for some other assignment. But if you have any issue, you can contact me over this telephone numbers. So student, revise whatever we has been discussed in the class so that you can perform well in your examination. Thank you for patient listening and have a nice day. Thank you, Jagbandhu sir. Thank you and have a nice day.
Thank you, sir. Thank you, sir.
Thank you very much.
Thank you. Thank
Thank you
you.
very
Thank
much.
you, sir.
Thank you. Session over.